The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A drop in consumer sentiment, a drop in business activity, and a drop in home sales, erasing the last 2 weeks of market gains. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. A lot of red on the screens today. We're going to set you up with what we're seeing in the S&P 500. Down around session lows, off by 1.7%. It's been a steady decline through the session. Also, about $2.7 trillion worth of options tied to stocks and ETFs expiring today. Maybe that is exaggerating some of the price action. You can see the Mag 7 off by 2.5%, so a lot of weakness in those big cap tech names. And of course, bonds are rising, so that's pushing yields lower, the 10-year yield at 4.41%. And WTI sliding below $71 a barrel, now with a 70 handle, breaching both the 50 and the 200-day moving average.
Yeah, we'll chew on this, Scarlett, because really the sell-off that we're seeing right now into the close is really the culmination of the last few days, quite frankly, the last few weeks of mixed economic data that today had Steve Cohen over at 0.72, striking a bearish tone in a speech saying U.S. growth likely to slow in the latter half of this year amid rising tariffs, slowing immigration, and of course the chaos of government cost cuts. A potential harbinger could be seen earlier today in the S&P Global's PMI data that showed the services sector, our main economic driver, contracting for the first time in 2 years. Meanwhile, you had a separate report out there on consumer sentiment, showing that sentiment has extended the early month declines, while the year-ahead inflation expectations jumped to the highest since 2023. And a lot of that is because of tariff worries. And those worries are fanning out now to the housing market as well, as data showed that sales of existing homes fell for the first time since September, as financing costs remain elevated around 7%, and listing prices continue to hold at about 30% higher than where they were 5 years ago. An S&P index of home builders now down 32% since peaking in October. That's the biggest drawdown in 2 years. And it's the only major sector out there that even comes close to that pain is actually in the managed healthcare space. An index covering those companies now down 24% from its peak amid a series of earnings disappointments, the appointment of RFK to lead the nation's main health agency, and now a news report that says the largest U.S. health insurer, United Health, has been under investigation, Scarlett, by the U.S. Justice Department for its billing practices.
Yeah, managed healthcare being one example of the massive U.S. services sector that is now shrinking. You told us about it earlier, but here's how it looks like. And you can see that services, which is in blue, falling below the dotted white line here, which separates growth from contraction. And you can see that, of course, services has done better than manufacturing, the white line here. And apt blame is uncertainty about the business environment due to tariffs and cuts in government spending. And while manufacturing in white is starting to rise a bit here, expanding for a second month, this may be the result of factories boosting output to get ahead of expected tariffs. In other words, Romaine, a temporary upturn.
Yeah, it'll be interesting to see how the market sort of digests this as we get deeper into next week and beyond. Darrell Cronk joins us here on this Friday afternoon to kick us off to the close. CIO of Wealth and Investment with Wells Fargo & Company and president of the Wells Fargo Investment Institute. Darrell,
how are you, Romaine?
What's the economy looking like to you right now?
Well, I think it spooked a lot of people. To your good point, it's not just today's data, but it's the last couple of weeks. I mean, retail sales a week ago today were weak. The housing data all week, starts, permits, now existing homes today. Mm-hmm. And I think maybe the services piece, which has been the stalwart, right? I mean, that if you think about the economy, what's happened is the services and the consumer have driven everything, and manufacturing and housing has been weak. Now, to Scarlett's good point, manufacturing is showing some early signs of ticking back up both U.S. And when I look at the heat map globally, some of those reds are starting to turn to yellows and oranges, which is a good sign, right? They're not at greens yet. But we need to see manufacturing pick up and we need to see housing stabilize, right? And we can't let the services and consumer fall off from the economic standpoint.
I mean, I know you're not really an economist, but when you look at that economic data, is it more kind of a symptom right now of how people are feeling, or is it about their actual capacity to spend? Because I feel like if it's more about sentiment and feeling, then in theory it could shift back to positive pretty quickly should things in Washington and elsewhere change.
Yeah, when you look at wage increases and other sources of liquidity that are out there, I don't think there's a lot of signs showing that they don't have the ability to spend. I think it's just the hesitation to, and I think that's spilling through into the markets too. When you look at the market activity, it's not that there's, up until maybe the last today or yesterday, massive selling, right? It's just people are sitting on the sidelines, and the option value to sit and wait has gone up, right? Because all the headlines, all the uncertainty, everything.
Yeah, and we should point out, too, even with the sell-off today, Scarlett, I mean, you still have an S&P above 6,000, not far off from that all-time high.
Absolutely. One thing I noticed is that the last time the S&P 500 rose on a Friday was January 17th, before the inauguration.
That's it.
Is there anything to that idea that people don't want to be long heading into the weekend because you just don't know what kind of weekend headline risk there is?
I think that's a fair point, Scarlett. It's exceedingly fair to today and this weekend. I think people are worried about what that, episodic headline, unknown over the weekend ends up being. I think your point about, option expiration today is adding some volatility to that as well. But look, I mean, we're going to close the books on fourth quarter earnings. We're probably going to crest, I think, at $250 on the S&P 500, which is well above the estimates of 243. That puts us a stone's throw, call it 10%, to the 275 number this next year. So between solid earnings, what has been lower interest rates as the bond market rallies, right, and up to the last 2 days, volatility. The MOVE index on the bond market is sitting at 3 to 4 year lows right now, right? So that's a good environment still for markets. Like, let's not overplay the last 48 hours too much.
That's fair enough. Is it a good environment for small caps? Everyone keeps talking about how, with the Fed not necessarily moving to cut rates any further in the near term, that kind of halts any kind of momentum the small caps had. Yet it really depends on what the earnings show, because ultimately, if they don't have the earnings growth to deliver, then, they're not going to be able to see much.
Excellent point, right? And the short answer is no, right? If you look at earnings growth for 2024 in the Russell 2, it's actually lower than it was in 23. So it's one of the few areas where you're going to see earnings contraction when we put that final numbers in the book. And the reality is the Russell 2 is sitting right on top of its 200-day moving average, right? It's tried to rally off of that 4 times over the last 9 to 10 months, and it just can't get there, right? And higher interest rates, higher inflation, all those things play into the business environment for small cap, right? So the short answer is no. I think small cap is, and in fact, if it breaks its 200-day moving average today, could be the canary in the coal mine that you want to watch for this thing to get legs lower.
Yeah, someone sent me a note on that this morning. I thought it was interesting. Bloomberg had a great story about how when we talk about tariffs and some of the chaos out of Washington, it's the small businesses that are probably much more susceptible here to sort of any negativity that spills from that. So from an investor standpoint, I mean, is your recommendation primarily to stay sort of with larger cap names, with kind of those cash flow generators that, let's face it, have been the main drivers of the rally for the last 3 or 4 years?
Yeah, I mean, you have to stay up in quality, right? Large cap. It's interesting, you look at the Mag 7 and they're underperforming even the S&P 500 year to date, right? They've given up. What's interesting is you're starting to see, international developed markets do well, right? The German DAX is sitting on all-time highs. Japan is doing well with a strengthening yen. So we're seeing a little bit of life there. We need to see if that's going to get legs. It's been a false echo for many years where people, value trap, where people jump in thinking this is the moment in time where valuations are cheap enough and you should get long international markets. The dollar coming down, right? The Dixie at 106 has helped coming off of 110. Yeah. But I'm not sure that's a sustainable trend. I think the dollar probably rallies back stronger again to 109, 110 on the
And you mentioned some of the moves we've seen. And I was taking a look at the German elections. I was surprised at how well the DAX has actually been performing in the face of all that chaos. But what about China? I mean, I was looking at the FXI, which tracks large cap Chinese names. I mean, it's like on a 6-week win streak right now. Kind of, obviously well below those all-time highs. But when you see the resurgence of Alibaba and Bilibili and some of these names, is there life there?
There's life temporarily. I mean, the MSCI, emerging market index is up 7% year to date. Again, besting S&P. China's the big piece of that. I'm not a believer unless they come with, a bazooka for stimulus, right? To really kind of help bring that. And I think that comes with its own travails, right? Because you bring a bazooka to the second largest economy in the world, and what is that? That's inflationary, along with a surprise higher in UK inflation, a surprise higher in Japanese inflation, US inflation being sticky. If you were to get that out of, the Bank of China, I think you'd have markets concerned, right? Because that amount of stimulus coming in is just going to push global inflation higher.
All right, Darrell, I've got to leave it there. Always a great conversation. Have a wonderful weekend. Darrell Cronk, CIO of Wealth and Investment over at Wells Fargo and Company, kicking us off to the close here on this Friday afternoon. University of Michigan out with the latest sentiment data. We're going to talk to Joanne Hsu, who leads those surveys here, and ask her exactly why things were so dour in the past month.
Plus, we zero in on the healthcare space, United Health, as well as major moves in GLP-1 makers after the FDA declared the Ozempic shortage over. So why shares of copycat Ozempic makers are slimming down.
And Hollywood awards season is upon us. Sadly, Scarlett and I did not get a nomination, but Duncan Crabtree-Ireland, he's going to be stopping by the program a little bit later. He was the main negotiator for the SAG-AFTRA union last year. He's going to stop by to talk about the SAG Awards, which are this weekend. You're watching The Close on Bloomberg.
Shares of United Health are tanking today on reports the Department of Justice opened an investigation into the health insurer's Medicare billing practice. Here now to detail how the potential investor impact might look is Michael Ha. He is senior research analyst at Baird. He's got an outperform rating on United Health with a price target of $640. Michael, we should point out that the DOJ declined to comment on the news, and United Health has pushed back, saying they're not aware of the launch of any new activity. But the reports from the Journal and supplanted by Bloomberg reporting as well indicate that this has to do with the Medicare Advantage program and payments from the government for that program. Can you tell us a little bit about how reliant United Health is on Medicare Advantage?
Yeah, thank you, Romaine and Scarlett, for having me on. Right, so Medicare Advantage is a large part of United Health's earnings. We'll call it even about a third of their health insurance business comprised of Medicare Advantage, and even larger portion if you include their Optum Health business as well. So overall, it is a pretty substantial part, but I will say that in terms of Medicare Advantage, the risk adjustment system, there will always be some level of fraudulent bad players, but at the end of the day, it's a system that accomplishes what it sets out to do, which is incentivize the healthcare system to focus on care for the most frail, high acuity elderly people. So ultimately, I think it's a very positive system.
Okay, so you're not reading too much into this report at the moment. And in fact, you say that this could provide a buying opportunity for the stock.
Exactly. We have 5 reasons why we believe United at these levels is, quite honestly, the easiest decision to make is to buy. It's probably one of the clearest opportunities we've seen in the history of us covering managed care. And number one, it's the fact that United issued a public statement this morning. They're not aware of any such DOJ investigation at all. Number 2, United trading at around 15 times PE. It's one of the cheapest valuations we've seen in United's history. And they've only approached these levels a few times in its history. We're talking the most extreme periods: 2020 COVID, 2019 Medicare for All rhetoric, 2014 to 16 after the Affordable Care Act. And number 3, Bill Ackman did follow up on his this with another tweet this morning. Ultimately, we think all of this PR battle will amount to nothing material. Number 4, anything related to Medicare Advantage risk adjustment, this scrutiny is not new at all. There's very active and robust oversight over the past decade. And we wouldn't expect.
Michael, let me just stop you there, because I mean, a lot has changed. I mean, when we go back to some of the softness in this stock, I mean, a lot of this predates whatever news flow there's been about an investigation, whether there is one or not. And we talk about that MedPAC report that came out, I think, last year at the tail end of the Biden administration, showing billions of dollars in potential cost savings if they shifted some of this stuff away from some of those private insurance companies. Obviously, whatever the heck Elon Musk is doing around Doge, which is also targeted Medicare Advantage. Is that not a risk that's baked into your model right now?
In terms of Medicare Advantage and Doge cuts, well, we'll address that first. Right now, Medicare Advantage is probably the most insulated in terms of policy change. Trump has been the most vocal, both on the campaign trail in his first administration and even actively today in supporting Medicare Advantage. And we believe United is on the right side of that trade. Where most of that focus is really on the Medicaid side, the exchange marketplace, where there's a right now it's a heated debate. But in terms of United, in terms of Medicare Advantage, in terms of bipartisan support, we believe it's on the right side of the so-called Trump trade. And I would say that United, in a U.S. healthcare system where, quite honestly, it was built on a flawed payment delivery model, United by far has the greatest ability to impact change and to fix the healthcare system, which I believe is very underappreciated.
Okay, I mean, that's fine. But again, when you look at the market reaction that we've seen going back from that peak that we saw in November or whatever of last year, it gets to this question as to, I guess, whether the news flow and more importantly, sentiment is working against them. And if so, Michael, when do you think that would turn? I mean, it's not, again, it's the investigation. It's the past reports. I don't even want to get into this whole mess that's going on with Luigi Mangione. But there is sort of a public sentiment right now, whether it's in the investment community or in the consumer space, that is decidedly against UNH right now.
Right, and that's a great question. So far, I've never seen sentiment this negative on health insurance and United. But it's important to remember the fundamentals have not changed whatsoever at all. And the future path is still as strong as it was back in November. In terms of catalyst path, we have a very near-term catalyst with, in early April, the 2026 final Medicare Advantage rate notice, we believe will be very favorable, and that should help drive United and the broader sector in the near term. Longer term, I think Trump is ushering a golden age for Medicare Advantage and value-based care over the next 4 years after Biden had been very difficult with his regulatory policies the past 4 years.
All right, Michael, going to have to leave it there. Michael Ha, of course, he is a senior research analyst over at Baird. A closer look at shares of United Health, down 7% on the day. And we should point out, down about 26% from its all-time high late last year. That's one of the big movers on the day, but that is actually not the worst. That title actually belongs to Akamai. Those shares plunging today after the company gave a weaker than expected outlook, leading at least 6 Wall Street firms to downgrade their calls on the stock. We're going to talk about one of those next in our top calls. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start today with Rivian. Cantor Fitzgerald hitting the brakes on the EV maker, downgrading to neutral after yesterday's earnings report. The analyst says, quote, "We are becoming more conservative in the near term," citing macroeconomic challenges like new tariffs as reasons behind the downgrade. The shares lower by about 4% here on the day. Next in line, let's take a look at Unity Software. HSBC upgrading the stock to a buy and raising the price target to $34 a share. The analyst says shares may have more room to run after the company reported those results that beat expectations, which offset a somewhat disappointing forecast. The shares fractionally lower on the day. We should point out they rallied 30% yesterday after that report came out prior to the market open. And finally, let's take a look at Akamai. It's the worst performer in the S&P today. Piper Sandler among 6 sell-side shops downgrading their recommendation on the internet infrastructure company. Piper cutting to neutral on the back of that earnings report that showed a weak outlook. And the analyst saying investors should look elsewhere until some of the dust settles. Those shares down 21%, and those are some of our top calls. And the man behind that last call joined us right now. James Fish is a managing director and senior research analyst over at Piper Sandler. And Jim, give us a little bit of sense here. When we talk about the dust settling, what is ailing Akamai right now, or at least what ailed them in the most recent quarter?
Hey, thank you for having me on here to discuss Akamai here. So, look, heading into this print, there was going to be some messiness to begin with. We had been warning investors that the 2025 setup relative to where the street was going to face some challenges just because of how many moving parts there were when you think about all 3 segments of Akamai across security, delivery, and compute. Whether it was the security organic numbers being a little bit elevated, the FX pressures that we've seen across a lot of names, the impacted the compute business, being a little bit of a black box overall, but going through a transition towards enterprise infrastructure as a service to compete against the likes of an Amazon, a Microsoft, a Google. And then on the delivery piece, which has been the core business for the company for a long time, it's got multiple moving parts, whether you want to talk about the Edgio contract acquisition that they just did, the US TikTok exposure, TikTok optimizations, just a lot of moving parts. And so we were a bit concerned, and we saw those cuts come in even more than what we had been warning. And so for a little while here, we're going to be stuck in the penalty box is kind of our view.
Well, that's what I'm curious about. I mean, for a company that kind of touches so many elements of the internet at a time where we see internet activity continuing to rise, you would think there would be benefiting. So I am curious as to whether this is something specific to Akamai, or is there something broader going on in the industry that we should be paying more attention to?
Yeah, I mean, there's actually a couple of things. One is structural. Structurally, the internet has been growing slower. We've been calling that out in what we call our CDN tracker for about 2 years now, as we've worked through a lot of normalization from the pandemic. It's crazy to think about. We're still talking about the pandemic in terms of normalization, but the space was seeing roughly 2 years of growth on the internet and compressed into each of 2020 and 2021. So really, you're seeing internet grow kind of low to mid-teens based on our tracker. You do have, of course, streaming applications and media applications outpacing that volume growth. But overall, we've seen much lower internet traffic level growth versus the 25 to 30% pre-pandemic. And then also, micro-specific to Akamai, they are transitioning their business more towards kind of bundled offerings between security versus delivery, and as well as delivery.
So I want to go back to TikTok for a moment, because that's Akamai's largest customer, and I think some analysts might have been surprised by just how reliant Akamai is on TikTok. But TikTok has decided to do some of its own content delivery rather than rely on Akamai. Is that a risk that Akamai runs with other customers as well?
Yeah, it's actually been something we've been seeing play out since about 2013, when Netflix, Google, Facebook back in the day went towards a DIY approach themselves. And so you've seen that with TikTok. You've seen that actually with another large customer like a Disney, for example, and a handful of others have at least some sort of DIY approach. But really, it's a move towards multi-CDN as you think about reliability. Akamai is really strong, and also diversification in case one of these networks has an issue that you can kind of switch over if you need to.
Jim, you just downgraded the stock to a neutral. What would prompt you to downgrade it further to a sell?
Yeah, I mean, look, the shares are clearly getting beaten up here. And part of the reason we had kept our overweight was this expectation of numbers coming down, but valuation kind of nearing a trough level, and clearly was worse than anticipated on sort of the denominator. So here we are today. But, what we're looking for ahead essentially is, what is TikTok going to essentially look like in some of these other large media customers? What does the core security business really grow? Can it hit the 3 to 5 year framework or not? And then do we actually have margin stability here? Because that's a pushback we're hearing today. The fact that we're having margins go down. And so is there pressure here on the overall?
Sounds like some existential questions then for Akamai. Jim Fish, really appreciate it. Jim Fish over at Piper Sandler. Coming up, we'll speak with Joanne Hsu of University of Michigan.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. Romaine, if I were to ask you where you think inflation is going to be in a year's time, would you be able to give me a number?
Yes, higher.
That's not a number. If you could specify a specific number.
Above where it is now. I don't know. I don't know. But you know what, Scarlett Fu? There are a lot of people who get paid a lot of money to do exactly that, find out exactly what people are putting a number on.
Well, according to University of Michigan, people are now looking for 5 to 10 year inflation to go up quite a bit. And this is something that, is weighing on markets today. They're looking for 3.5% inflation over the next 5 to 10 years. Joining us now to discuss all of this and to get beneath the numbers here and tell us what the story is, the bigger story, is Joanne Hsu. She is director of the surveys of consumers and a research associate professor at the Institute for Social Research at the University of Michigan. Joanne, great to speak with you. And I think the question that I posed to Romaine says a lot, because it's not clear to me what goes into someone's answer beyond recency bias. We've seen prices go up, so we expect prices to go up further. How do you put a number on that?
So what's really interesting is that people are taking in a whole bunch of different types of information when they're forming their expectations. They are looking at where prices are right now, but they're really also thinking about forward-looking factors. And so the big reason why we have seen inflation expectations surge over the last 2 months is because people are really bracing for the impact of tariffs. They're really worried that tariffs are going to lead to price increases that are going to be passed down to consumers. And they're telling us this loud and clear throughout the interviews that we conduct.
Right. And I mentioned the 5 to 10 year inflation outlook is a 3.5% increase. For the 1 year inflation outlook, it's 4.3%. Is a long-term outlook like 5 to 10 years useful when people don't even know what's going to happen this weekend? I mean, are consumers doing much more than, again, relying on recency bias and to some extent, playing off of their mood, making somewhat of a wild guess based on how they feel?
Well, two things. First of all, people are looking at what's happening right now, but the fact that the 1 year and the 5 to 10 years are not the same and that they don't always move together tells us that consumers are really distinguishing between the short run and the long run. And the other thing is, I think it's instructive to look at previous periods where we've had large surges in long run inflation expectations. This 0.3 jump that we saw this month added to the 0.2 jump that we saw in January, that is a very large 2-month increase. And the last time we saw a surge this large was in 2008. What was really different at that time, though, was that those inflation expectations only spiked and came down really quickly. And the reason for that was this was happening in the middle of an oil price shock. People were responding to oil prices, and they were really worried that that was going to pass on to long-run inflation. But as it turns out, after peaking in June of 2008, those oil prices came down really quickly. So that's what's really troubling about right now, because people are worried about tariffs. And all the signs that we've gotten is that tariff policy, tariff hikes, trade wars are going to continue. So unlike the oil prices from 2008, this isn't something that's necessarily going to go away quickly.
Well, that jumped out at me too, Joanne. So if indeed this sort of shift in sentiment is about the anticipation of higher rates, and we talk a lot about this on the show, particularly with the Fed and the whole idea of trying to keep inflation expectations anchored, as they would say. Is there any sort of parallel in history and the history of these UMich surveys where there's a real snapback in some of those anticipatory thoughts, the sentiments, I should say? What can change that and how quickly?
We're in a very unique situation right now. In the earlier periods where we had a huge surge over a very short period of time in long-run inflation expectations, not just 2008, but also in earlier periods, it's very largely followed oil prices. And that just isn't part of the calculus right now. So this is concerning. So it really depends. I think we need to wait to see what the tariff policy continues to look like and how quickly things get passed on to consumers, or if at all. It could be that if tariffs continue to go up and consumers aren't really seeing that on their pocketbooks, these inflation expectations could come down. But at the same time, we also have some part of the population who's expecting these policies to actually lead to deflation, and they may get very unhappy and may adjust their own beliefs if that doesn't come to pass soon.
Well, I am curious, though, too, because when we look at some of the components, particularly kind of the sentiment around durable goods, obviously those bigger ticket purchases, washing machines and refrigerators and those types of things as well. If those big ticket items are being put off, is it a put off, or is that sales sort of lost, I guess is what I'm trying to ask you.
What we're seeing is actually the reverse, where we saw a surge in big ticket purchases last November, December, with strong durables purchases and strong auto sales. And that was consistent with what we were seeing in our survey, where people said, you should buy these things now before the tariffs kick in and before prices get worse. And that's why we're seeing a deterioration in buying conditions now, because now people think it's too late. Now, of course, we haven't actually seen those surges in prices yet. So there is some uncertainty about how this will continue going forward.
Yeah, but I mean, that can become kind of a self-fulfilling prophecy. If you think prices are going to go up and you start buying now and you kind of expect that that's the case, oftentimes we'll see that kind of does get fulfilled. I want to ask you about another part of the survey, which is that more than half of consumers now expect unemployment to rise over the next year. How much of that is divided along partisan lines?
So I would need to check the tables, and I'm not completely sure what the partisan breakdown looks like for unemployment rates. But the key thing to note is that we see independents in the middle who are seeing a deterioration on multiple dimensions in the economy. Independents have historically been in the middle, between the two ends of the partisan divide, and have been near the national average. And independents in particular are seeing weakening business conditions, personal finances, inflation, worse inflation, as well as worse unemployment rates.
Okay, got it. In terms of political leanings and the flip-flop that we've seen when the election happened and certainly when the inauguration took place, are there any new developments on that front that are maybe things we need to pay attention to? Has the Republican response started to shift a little bit, or the Democratic response?
We saw a little bit of a moderation in the surge of confidence that we saw among Republicans immediately after the election, but the partisan divide remains very, very wide. And that's a reflection of our polarized society. And we've seen this for years. So this partisan divide in consumer sentiment has been visible since at least the Reagan administration. So this isn't something that's peculiar to the survey now or peculiar to this current political climate. That being said, again, the national averages are very instructive, and independents are the ones to watch.
All right, Joanne, really appreciate you taking time for us. Joanne Hsu, the director of the Surveys of Consumers and a research associate professor at the Institute for Social Research at the University of Michigan. I thought the data, I mean, maybe it was kind of the 1-2 and maybe 1-2-3 punch of the other data that also came out, of course, with home sales falling. Then, of course, with those PMIs, global PMIs showing that drop in the services sector here in the U.S. And I think put that together with consumer sentiment numbers, and that really sort of seemed to rattle the market.
Right. There's a lot of uncertainty out there. People don't feel good. They don't feel settled. And that's showing up in all sorts of ways, even with equity prices near record highs. Yeah, well, right now you've got more than 300 names in the S&P lower. Stocks right now near session lows and some big drawdowns in some individual names, including Hims and Hers, but not necessarily for the reasons that you think. Those shares are down 25% right now, biggest decliner in the S&P mid-cap index. This after the Food and Drug Administration here in the U.S. said no more shortage, Scarlett, of those GLP drugs that they had been reliant on here for some of their growth. We're going to talk about what it means. That's coming up next in our Stock of the Hour. This is Bloomberg. Let's take a look at one of the biggest movers of the day, Hims and Hers Health. This is the telehealth platform having its worst day since it went public back in 2019. This after the Food and Drug Administration here in the U.S. said that the shortage of Novo Nordisk, Ozempic, and Wegovy is officially over. Now, this means compounding pharmacies like Hims and Hers can no longer make exact copies of Novo's brand name drugs. However, they can still make alternative versions with modifications. Here to try to explain all this is Jess Minton, who leads our equity coverage here. So I'm a little confused by the market reaction. On one hand, this sounds like they may have to stop selling this stuff. On the other hand, the FDA is kind of saying, well, not right away. You can keep selling this stuff for now, but at some point in the future, we may actually pull the rug out from it.
And this isn't the first time we've seen this happen with this particular stock. So there's a lot of moving pieces with this. Specifically with today, the FDA was ruling that when it comes to the substance that goes into those types of weight loss and diabetes drugs, particularly that Hims is basically manufacturing and selling, because there had been a shortage, especially for Novo over the last few years, that they can no longer do that. And a lot of people might not realize when it comes to those drugs and the generic ones that a lot of those off-brand, when you're thinking about the telehealth companies that do it, that they're allowed to do it as long as there is shortage, but if there isn't a shortage, they can't do that right now. So that's why you're seeing Novo stocks up when you're looking at the U.S. listed shares, but Hims getting pummeled. But again, a lot of this goes into this type of story, because if you think back to October 3rd, we saw something similar with the FDA when they were talking about more specifically the components that go into the weight loss and diabetes drugs for Eli Lilly. Those were no longer in shortage. You saw Hims stock drop about 10% that day, but then also the FDA kind of walked it back a little bit a few weeks later, but ended up pushing back and saying those were off the list. So I think what happened here, though, Novo was expecting to come off of that shortage list this year, but it came in a little bit sooner than anticipated for investors.
I think you guys were talking about this a little bit earlier, but if it's no longer in shortage, that means everyone's going to go flock to the brand name drugs.
Right.
won't that just create a shortage once again? I mean, we're just going to move in this cycle.
And that's exactly what Hims CEO was pushing back and talking about today, because Novo just a few weeks ago was talking about how when it came to some of the supply chain constraints and also the shortages, they were expecting potentially to see more shortages in the shorter term. So obviously the CEO of Hims is trying to kind of walk that back and also see that potentially they could still have that when you're looking at what it's putting into those types of drugs. But also, this isn't the bulk of what generates the type of business model for Hims. I mean, this is something obviously that has propelled the stock over 400% over the past year. It was just trading at a record last Friday.
So how much of this does comprise of Hims' overall revenue?
Yeah, so actually the other drugs that come into its revenue, Cialis is a big one too. And then also when it comes to menopause type of drugs, and then it also has other weight loss types of items there. So this isn't necessarily the bulk of the revenue when you're thinking about what's driving, more than half of the percent of the revenue growth there. But this is something that it put it on the map when you're thinking about what it was doing with those types of weight loss drugs.
I am curious, though, when we talk about these companies, meaning the branded companies, I mean, they're basically saying they're already operating at production capacity.
Right.
So, I mean, if you remove a Hims and Hers and Roe and Dunn Health and some of these other companies that are doing all this stuff, I mean, wouldn't that just create another effective shortage if those folks have to go back to the branded medication?
And that's what basically Hims is trying to bank on, and their CEO, because of what's happening with that. And especially when you're thinking of the other types of drugs. I mean, it wants to continue to move forward with this, but it's the question of, especially because some of these telehealth companies were trying to push back, and there's some things going on in court against what the FDA is trying to do here. So it remains to be seen sort of how this all plays out, but there's millions of Americans that are depending on these types of weight loss as well as diabetes drugs. So that's why there's a window the FDA was giving about 60 to 90 days. But again, when I've been talking to analysts, they still feel like this could go on for a year, maybe even longer, just because you can't just all of a sudden pull this off for people.
All right, Jess Menton giving us the lowdown here on Hims. The stock tanking right now, down about 25% on today's trade. Coming up, we're going to take you to the closing bell with Ed Clissold, Chief U.S. Strategist with Ned Davis Research. This is The Close on Bloomberg.
When you look at the market activity, it's not that there's, up until maybe today or yesterday, massive selling, right? It's just people are sitting on the sidelines, and the option value to sit and wait has gone up, right? Because all the headlines, all the uncertainty, everything.
Darrell Cronk over at Wells Fargo kicking us off to the close just about 50 minutes ago with stocks at session lows, the S&P and the NASDAQ testing some of those shorter-term moving averages, and the Russell 2000 setting up for what could be its first close below its 200-day, Scarlett, since late 2020.
Yeah, it's a technical level that's bounced off of several times, but it does look like we might be below that level at this hour. You look at the equity screen, and there's a lot of red there. You really see it in the transports as well. Truckers are the biggest drag on the Dow transports. According to JP Morgan, Amazon's plans to build up its own less-than-truckload capabilities could be a risk to Old Dominion and some of those other kinds of companies. And where's their buying? In longer-dated treasuries. TLT, the ETF that tracks those longer-dated treasuries, up 1.3%.
Yeah, and you take a look at sort of benchmark yields right now, setting up for a sixth straight week of declines here, with today being one of the biggest of the weeks. The VIX elevated back around that 19 level here. And of course, stocks now erasing most of the gains from the past couple of weeks. Ed Clissold joins us right now, Chief U.S. Strategist with Ned Davis Research, to help us get you to those closing bells, which are just about 8 minutes away. And this is a market that has been a little bit off kilter for a while now, whether it's sort of concerns, Ed, about what's coming out of Washington, and certainly over the last couple of days with some of the economic data that seems to suggest some softness. Are you willing, or at least are you able to look past some of that economic data and see a brighter future?
So if you take a little bit of a step back, Romaine, the most of the information, the data coming out is still pretty positive. It's just that the amount of information coming at us has just multiplied, and it seems like every day, there could be some surprise that comes out of Washington that throws the market off kilter. But look, leading economic indicators, 6 months change, still positive. 76% of companies beat expectations in Q1, and up through yesterday, the S&P was up 4%. So a month and a half into the year, that's a pretty good start. 10 out of 11 sectors are up on the year, and the 11th consumer discretionary is down less than 1%. So all the wrangling over the Mag 7 dominating the market, that's kind of gone away. And so, yeah, the market's had a hiccup, and we'll have to just see how it takes it. But up to this point, it's managed to take some of those body blows pretty well.
They certainly have. And I mean, I guess it's a good thing that we did see a broadening of what people were willing to buy. Of course, we know that at least for the aggregate market, the problem is those names don't have the same weighting. And I am curious about the sustainability of this rally if we don't see the Mag 7 get back in gear, particularly with NVIDIA being down 4% today, and of course with the big earnings report coming up next week.
Yeah, so from a cap-weighted basis, you have to have them at least participate. So what we were saying last year was that it was okay that the generals were leading as long as the infantry was still following, which they were. So most stocks were up last year, just not as much as the mega caps. I'll flip that and say kind of the same thing for this year. It's okay for the biggest stocks to not do as well, but they still need to be contributing to the market. Because otherwise, what you're going to be talking about is that eventually there's going to be a loss of faith if the blue chips can't pull their weight. So that's something we're keeping an eye on here. It's a delicate balance. So far, the market's pulled it off, but yeah, we can't have the mega caps, in a downtrend. That would probably put the bull market at risk.
Right. I'm looking at the data points that we did get, and Romain mentioned some of them: S&P Global PMIs, University of Michigan, existing home sales, all disappointing. That's dragged the Citi Economic Surprise Index to a 5-month low. Are there starting to be rumbles or concerns that we will get a soft landing as opposed to no landing, or maybe even a hard landing? Is that coming up in conversation at all?
A hard landing hasn't been uttered too often over the past week or so from our clients, but the idea that there could be more of a softer landing is part of the discussion. Like, we have a recession watch index that's 10 different data points. None of them are in recession territory at the moment, so I think it's more of a soft landing. But what that could do, though, is it could potentially bring the Fed back into the picture. Part of the challenge over the last week or so is that that next rate cut's been pushed out to the second half of the year. A little bit softer economic data, could potentially bring the Fed back into play, because when the Fed moves slowly, that is, say, every other meeting or so, that's actually a great environment for stocks, because it means the economy is still doing okay. The Fed can take its time to watch and decide if they can move again. Now, if they pause for too long, say more than 6 months, historically, that's led to a pullback in the market.
So in other words, right now, bad economic news is bad news for the stock market, but at some point, the bad economic news will become good news again for the stock market. Ed, I want to also ask you about the German snap election on Sunday. Is that perhaps holding people back a little bit? I recognize that German stocks, not much overlap with the U.S. stock market, but in terms of sentiment, in terms of, this idea that people don't want to get ahead of big headline risks over the weekend.
Yeah, the chaotic information that seems to be flying at investors on a daily basis certainly has played into things, and this is just another example. Why would you want to have risk on if something could come at you over the weekend? But there's another side to this. We have some sentiment composites that we follow at Ned Davis Research. They were showing some of the most optimistic levels we've seen in the past decade right after the election. That's come back a little bit. So from a contrarian standpoint, that's a good thing. And, the American Association of Individual Investors weekly survey, that's at a multi-year low in terms of the number of bulls versus the number of bears. Yeah. So, some of this, some of this news flow is actually maybe taking some froth out of the market. So as long as the fundamentals stay intact, maybe it's a good thing for the longevity of the bull market that we don't have some sort of euphoric top that we could have been marching towards right after the election. All
right, Ed, got to leave it there. Ed Clissold, Chief U.S. Strategist with Ned Davis Research, helping us count you down to those closing bells. Just about 3 minutes to go with stocks pretty much across the board at session lows. I was just taking a closer look, though, too. We talk about, Scarlett, the participation of those broader cap names and bigger cap names, I should say. And they have really been slow. I mean, I was taking a look at Meta, which, of course, had been the darling for a while here. It looks like that 4-week win streak is going to come to an end. But you got names like Amazon that have been down for 3 straight weeks. Of course, we know about all the doldrums and at Tesla down for 5 straight weeks. Google's not doing much better here. And Apple, I had a little bit of a bump the last couple of weeks. That's kind of fading as well.
Although I believe Apple is still the only Mag 7 name that's outperforming the rest of its peers. Nope, it is now turned into the red as well. It's down 0.1%. Consumer staples, the only sector in the green right now.
Yeah, so it's a big question as to where the leadership is. Obviously, NVIDIA is going to be sort of the big catalyst, potential catalyst, I should say, at least among large cap names next week. And after that, who else you got? I mean, a few retailers and what? I mean, what's going to have the weight to really move the market?
Fed speak.
Oh, gosh. Did you listen to Philip Jefferson's speech today?
No, what did he say?
I didn't listen either.
Okay.
But anyway, I'm sure they said something. And of course, a lot of people are keeping an eye on rates, which are down, at least on a benchmark basis, for 6 straight weeks now. A lot of catalysts moving this market. A full breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bosticure with Scarlet Fu taking you through that closing bell. A global simulcast starts right now. Carol Massar and Tim Stedevik join us from their radio booth as we welcome our audiences across all of our platforms, including those of you watching on YouTube. And we are watching right now, Carol, a pretty interesting sell-off here, down about 1.7% on the S&P 500. But I think it's the complexion of this sell-off that's causing a lot of agita.
I love how you say that. There's some weak economic news, right? We continue to watch news out of D.C. There's concerns about, reports of a possible new coronavirus. And so you kind of add it all up. There's really definitely a risk-off trade in today's session.
Yeah, you really saw it time-stamped, 9:45, 10 o'clock when we got some of that economic data, consumer sentiment, housing services coming in weaker than expected, unsettling investors. And then a little afternoon, Scarlett, when people started really paying attention to this report from the South China Morning Post that actually came out yesterday about a possible new strain of coronavirus.
Let's not forget also there's $2.7 trillion of options tied to stocks and ETFs expiring today, which may be exacerbating some of the price action as well as we bump along the bottom here heading into the close.
Heading into the close, and of course, heading into another important week next week, particularly when it comes to earnings. We have NVIDIA on tap, which is obviously the granddaddy in terms of leading this market rally. And I guess the question is, given it's down this week by 3 or 4%, can that sort of save this rally?
Yeah, it is a big question, right? Whether or not, they see any kind of weakness, that is certainly going to disturb investors, no doubt about it. Right?
A lot to talk about here today as we get the closing bells in New York with the Dow and S&P, NASDAQ. Well, let's just call it all the major indices in the red on the day, and it appears on the week. The Dow down more than 700 points, or about 1.7%. The S&P 500 lower by about 100 points, or 1.7%, and it does look like it is going to close below that 50-day moving average. Similar story for the NASDAQ 100. The NASDAQ composite down more than 400 points, or 2.2%. Let's take a minute, though, to take a look at the Russell 2000. The Russell 2000 lower on the day by almost 3% here on the day, and it is now officially closed below its 200-day moving average, the first time that has happened since late 2023.
All right, that's pretty significant, no doubt about it. I want to just draw your attention to one group, and that's the trucking names. They're down almost 5%. You did have JP Morgan analysts highlighting potential risks coming from Amazon's freight plans to build up its own internal LTL, less than truckload capacity. So there's one sector, Scarlett, that we definitely saw under pressure today.
Absolutely. But you look at the IMAP and it's clear that the pressure is pretty evenly distributed. There is one green spot, that is consumer staples. Those are your classic defensive names. Utilities also little change on the day, but all in all, lots of red. In fact, with 7 out of the 11 groups in the S&P 500 down at least 1%.
All right, guys, I'm going to get to some of the gainers.
Big gainer today.
There you go.
Yeah.
Well, I have
Times
to
get
say,
tough, eat more chocolate, right?
I was so nervous that all my gainers were not going to hold, but they did. Aren't we happy?
And you did 4.
I did 4.
It's so risky.
I know it was. I had to, because I feel like there's like a lot of fundamental stories at play. Alibaba up about 6% here. This one up something like 14% this week, up almost 50% this month, up almost 70% year to date. It has just been on a tear.
You've been waiting years for this, Carol.
I have been watching this over the last couple of weeks. There's a lot going on. The DeepSeek-driven AI rally has just caused all Chinese names to go higher. But you also did this one reporting higher sales and saying it will boost spending on AI over the next 3 years. So it is still down a lot from its peak back in 2020, but it has been on a tear, including in today's session. We mentioned the reports of another possible coronavirus out of China. We got to watch this one, but there's still, if there's something, it's very early on. But again, it's just a developing story. Moderna up 5%, though, as a result. So we did see also Pfizer higher in today's session.
Why are you scaring people? So I mean, just so the story. But can we just make it clear? I mean, this is something they found in a lab.
Correct.
In bats.
Correct.
It's contained to the lab.
And it happens a lot.
And it's contained to the bats. And,
right.
And at least for right now, it hasn't transition to humans.
We talked to Madison Muller, and she said these coronaviruses happen a lot.
Yes.
But, we definitely did see the market move. I'm not trying to freak anybody out.
It's the weekend.
Investors, maybe we should be more worried about bird flu than another coronavirus.
Great point, actually.
Hey, maybe we should all just have a Celsius
I don't
drink.
eat birds anymore.
All right. Let's get to Celsius.
Actually, I had chicken from
soaring 28% in today's session. Company said it would buy Rival, Alani Nutrition for $1.8 billion in cash and stock. Including $150 million in tax assets. Anyway, investors moving into that one. And I got to mention Nissan. The ADR is up more than 5%, even though its credit was cut to junk by Moody's over its aging lineup.
What?
FT coming out saying that high-level Japanese group is planning to seek an investment from Tesla in Nissan. But
Tesla.
See? Okay. All right. I'm not freaking anybody out about coronavirus.
Do you know how many
bringing it up.
decliners I had to choose from, Carol? And I only picked
It was an embarrassment of riches.
I only picked 3.
You had so many.
I wanted 4. I wanted 5.
It was harder
I follow
for me
directions, though.
to have gains. Yeah,
Okay.
I've never been known to follow directions.
That's fine. That's why we love you. I want to start with shares of United Health Group. Actually, by far the worst performer in the Dow. Yeah, you heard me say it. Down 7% today. This after the Wall Street Journal reported that the Justice Department has been investigating United Health Group Medicare billing practices. The Journal did report the civil fraud investigation into whether the insurance giant's practices related to patient diagnoses force higher payments from the government's Medicare Advantage program. Hims & Hers Health falling today by 26%. It's the most ever for a daily decline. The FDA said that the shortage of Novo Nordisk's Ozempic and Wegovy has been declared over. Remember, Hims and other telehealth companies, they sell these compounded versions of the weight loss drug Wegovy. They do it at a discount. They're able to do that through this sort of loophole when these drugs are in shortage, but demand is high. U.S. regulations allow pharmacies to make copycat versions of these drugs in shortage. They have been given a period of time where they're still allowed to do this because they're not being cut off right away. Certainly, this did catch investors off guard. Interestingly enough, though, shares were actually higher pre-market after the company announced the acquisition of a peptide manufacturing facility. And finally, Rivian shares down 4.7% today. The company warned it's poised for a first ever decline in EV deliveries in 2025. It's a new challenge for the company after they achieved a long-held goal of profitability.
Let's take a quick look at yields. That was a big part of the story this week. It looked like it was going to be somewhat of a middling week, but we saw a big drop today here, definitely on the back of that economic data, down roughly 7 to 8 basis points across the board, at least for your 10-year yield now. This is the 6th straight week that we've seen yields move lower. For the 2-year, I believe we're now in week 2 of that, but of course, a much different direction than what the market had been betting on, which had been all in on those steepener trades. Those trades really blown up this week. It'll be interesting to see some of the CFTC data coming down the pike this afternoon and whether how married the market is to that trade.
All right. So speaking of the market, it is kind of an interesting day. We definitely saw a risk-off trade, and you saw the VIX move up, so volatility is certainly creeping its way in. But, having said that, I did find a bunch of gainers. I feel like not everything was down across the board. And so I think next week will be interesting to see, economic news as well as NVIDIA and the retail earnings news, too, to see what it says about the U.S. consumer.
Are the dip buyers going to come in? I mean, how durable is this rally? How reliant are these dip buyers? Because it does seem like throughout this rally over the last couple of years, every time there has been some sort of little correction, I don't want to use the term correction, but some sort of little sell-off, the dip buyers have come in. When does that stop?
Maybe we need to wait for NVIDIA to report the results, although it doesn't feel like people are really talking about it as a catalyst the way that they have been in the past.
Well, I think the people are kind of scared. I mean, given how far this stock has run here and given DeepSeek and everything else, the big question is that trajectory in place? But remember, it's not just whether the health of NVIDIA sort of keeps and propels this rally, but when you talk about names like Home Depot, names like Lowe's that are supposed to report here, you're going to get a much better read on consumer spending in light of some of the data that we got today. And then you get a lot of other other companies, your TJXs and American Auto Parts.
Wait, do you actually agree with what I said about the importance of the retail earnings next week?
I do.
Wow.
I agree with you a lot of times. I normally don't say it out loud. I know it goes straight to your head. But I mean, in all seriousness, though,
yeah.
it's like we've been asking this of every guest on this show today here about really their take on the U.S. economy, not just whether it's healthy, but is it healthy enough to really keep the rally going?
No, and I think it comes down to that, right? Even if we continue to see the Fed, on hold, inflation still kind of sticky. As long as there's economic growth, right? Companies are going to continue to hold on to workers. Workers are going to continue to, go shopping and buy things. So you have to think about that follow through.
What about the federal government and layoffs at the federal government level? What about the cuts that DOGE is making? To what extent does that affect the economy? Does that affect consumer spending? Does it affect the market in the Washington, D.C. area?
Well, did you see those comments that Scott Cohen made over at the Miami conference today, basically saying that he's expecting a downturn in the economy in the second half precisely because of Washington policy? And that's a big issue, Scarlett. I mean, we talk about this idea next week where we are going to have that budget vote in the House. There's going to be a big fight over that and a lot of questions to what Tim just raised there, Scarlett.
Yeah. Well, for now, bad economic news is bad news for the stock market. I guess if we get to the point where it's just a flood of bad economic news, at some point it's going to flip and people are going to say, well, the Fed's going to come in and ride to the rescue. All
right. This just means I'm going to have pizza tonight and a nice bottle of wine and go watch a movie. I'm just going to tell you that.
When is the wine segment today?
No wines. Can you believe that?
If any day we needed one, it would be today.
We all need a wine
segment. Your
segment.
producers and bookers are slipping.
Emergency wine segment, please.
The news flow is keeping us busy. All right, guys, that's a wrap. Have a good and safe weekend. All right, meanwhile.
They're the best. They're the best.
They are. That's our cross-platform. Radio, TV, YouTube, Bloomberg Originals. Do have a good weekend, everyone. Our team, TV's team, we'll all see you again, same time, same place on Monday.
And with markets, of course, on edge about what's going on here in the U.S., attention this weekend will turn to Europe. With Germany's special election happening over the weekend, we're going to have a discussion right here on The Close about the broader geopolitical implications. Hope Harrison over at George Washington University will be joining us in just a bit. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. I think the economic data we got this morning really gave the market an opportunity to kind of rethink the rally a bit. And you saw a massive sell-off. Take a look at the screen behind me, a 1.7% drop on the S&P 500. Yes, it did hold that 6,000 level. It did not hold that 50-day moving average. A close right at that level on the day. But more importantly, when you go down the market cap list here, the Russell 2000 closing below its 200-day moving average for the first time since late 2023. Managed healthcare stocks really took it hard on the chin today. We're going to talk a little bit about that in just a second. You look at where yields ended the day, but there are some bright spots out there, Scarlett. And I do want to highlight this rally that we've been seeing in China. This is the FXI ETF that tracks large cap Chinese names, up now for a sixth straight. This is the longest win streak they've had going back basically to the pandemic of 2020. They're well below their all-time highs, but I think a lot of people are pleased with some of the percent gains we've seen so far this year.
It goes to the idea that a lot of people are switching out of U.S. stocks and looking outside of the United States as potential places to go because there's more value to be found. Of course, Romaine did mention the managed healthcare space. Let's talk about United Health. Down 7% on the day, although it did fall as much as 13% in trading on reports that the Department of Justice is investigating the insurer's Medicare billing practices. We should mention that the DOJ declined to comment on this report, and United Health says it is not aware of any such investigation. Hims and Hers losing a quarter of its value today. That telehealth company, of course, a loser here as the FDA says that the shortage of Novo Nordisk's obesity drug is over, which likely puts an end to Hims making compounded version of the drug in the next 60 to 90 days, although we know that in the past that has gone on for a little bit longer past that 90-day deadline. Novo Nordisk, of course, a beneficiary of that announcement, up 5.2%, or at least its ADRs are higher. All right, let's get to our top story this hour. A high-stakes election in Germany. After 3 months of campaigning centered on immigration controls and a slumping economy, German voters head to the polls on Sunday. Current Chancellor Olaf Scholz is on course to lead his party to its worst result since World War II, while the frontrunner Friedrich Merz has pledged to not raise taxes. Of course, investors have already priced in the prospect that MERS will quickly form a coalition government. This is all reflected in the price action. German stocks near record highs, and European stocks have outperformed the S&P 500 this year. Romain?
All right, but first, let's take a quick look here at what's been going on in the U.S. market and how things really shook up. It's our Factor Friday. Chris Cain joins us as he does here on Friday afternoons of Bloomberg Intelligence. Let's start off with the factors that actually worked this week. I mean, we've been talking a lot of gloom and doom. How did financials shake out?
Well, financials have done pretty well, over the last 12 months. It's been very high on our sector scorecard. But one of the things we did is we looked at factors within sectors, which is kind of unique, right? So instead of taking the whole index and applying our factors, we looked at just financial stocks and seeing which factors worked in those. It was pretty interesting. It's very different in the whole market. So the two that really stand out to me is that value has actually really worked well within financials, meaning cheap has beat expensive, and the low volatility factor has really not worked well within financials, meaning high vol financials have beaten low vol financials, and that's pretty dramatic. I mean, over the last 12 months, we have high vol financials up 45%, while low vol financials only up 25%.
That's a huge, huge spread. Is high volatility financials a winning strategy beyond that over the longer term?
In a word, no. I say the factor is low volatility. So, right? Sometimes people say low beta or low risk, right? That's the factor that has historically worked and people use, right? Because those companies tend to outperform, especially on a risk-adjusted basis, their high volatility cousins. When you look, further back in history, like back to 2002, the low volatility financials are up about 900%, where high volatility financials are only about 500%. It's this very similar thing that when you look at the whole market, you have low volatility outperforming as well. And I would even say that that underscores how well low volatility financials have done, because they've gotten that return, but they've naturally done it with lower risk. So when you look at something like a Sharpe ratio, it's much better.
So, I mean, what kind of stocks are we talking about here? I assume we're not talking, the JP Morgans and Goldmans of the world. Like, what are sort of these high vol, if you will, of financial stocks?
You could probably guess some of them.
Yeah.
So things like Square, right? Block.
Yeah.
Coinbase.
Yeah, Coinbase. Wow.
Coinbase.
Yeah.
Even things like Capital One, right? Capital One is very high volatility. And then the other side, the low volatility financials, things like S&P Global, CME Group, and even Berkshire Hathaway is very low volatility financial.
Yeah, and we're actually expecting, of course, to get their shareholder letter and their earnings over the weekend out of Berkshire. Yep. So we'll see.
I bet there's a lot of cash sitting on the balance sheet there at Berkshire Hathaway.
Yeah, when are they going to put that to use? That's the cash on the sidelines.
That's a perennial
right
question, yeah. Chris Cain of Bloomberg Intelligence, thank you very much. We should just recap what happened in trading today, because it's pretty remarkable. Big sell-off, and in fact, the indexes closed near their session lows. The S&P 500 losing 1.7%. As you mentioned, some key technical levels as well.
Yeah, and I think those technical levels are going to really sort of drive, I think, the trading. We talk about this idea of dip buyers. I mean, when we were talking on the simulcast with Tim Stenovic and Carol Massey, we were kind of posing that question here. Okay, we've hit those levels today. On short-term averages on the S&P and NASDAQ, the long-term moving averages on the Russell. Yeah. Is that going to be enough to really bring back people? There's a reason why the stocks hit those levels.
Absolutely. But, the fundamental backdrop, I'm not saying it's bad, but the headlines are not great right now, especially the economic data, right?
Yeah, it's certainly not a pop the champagne and, all it's good times. If consumers are skittish, and that is the driver of the U.S. economy, then what else do you have?
Yeah, the PMI showing that the services sector now contracting was a big shift, certainly, because that's the driving force for the U.S. economy. The manufacturing sector expanding, but, maybe companies are just front-running the tariffs.
And I think it's interesting, too. I think, I don't know if you have it up there, but, I mean, when we look at what happened in the commodity space, too, that seemed really telling, too, certainly of institutional investor sentiment. Gold continuing that run toward a record high, the softness that you're seeing in the oil space and gas, for that matter, in the past week because of geopolitical issues. And you sort of throw that all together, and we've got to reset and do all this again next week. Yeah. More earnings, more economic data, more announcements by the White House, and, of course, a consequential election in Europe.
Yeah, it's a classic risk-off trade on a Friday heading into the weekend, especially with some weekend risk when it comes to headlines.
Yeah, and have you seen the price of eggs?
Don't even get me started. Yeah. It's like $18 a dozen at the local H Mart.
Yeah, I finally saw a surcharge in a restaurant for it.
Really?
Yeah,
what did they say? How much
was
$1? Really? Yeah. Was this a breakfast place or just?
Yeah, it's one of the takeout places. You get the little bagel sandwiches, and they're like, extra $1.
All right, there you go. I'm not buying eggs this weekend.
All right. We'll be back in a moment. This is Bloomberg. All right, we're counting down to a big election in Germany. The front runner there and the Chancellor Olaf Scholz making their final pitches. This as the nation is in what our next guest calls the most challenging position geopolitically in decades. Joining us right now to discuss is Hope Harrison, professor of history and international affairs at George Washington University, and really one of the preeminent scholars in this space. And Hope, I think a lot of us are watching this for a lot of reasons. Obviously, there are huge economic implications, national security implications for Europe. But I also want to start off with just the backdrop of German history and the idea that you have a far-right party that has risen to prominence, for better or worse, despite all the efforts Germany has made to sort of atone for the Holocaust. And you have this election coming basically a month, just a few weeks, if you will, after the 80th anniversary of the liberation of Auschwitz. And I am curious as to how the German people themselves are approaching this election.
Yeah, the German people are fully aware of how important this is, and most of them feel this is incredibly consequential and that the future of the country is on the line more than ever before. The rise of the far right, which has doubled its electorate, it seems, over the past 4 years, has really panicked many Germans, tens of thousands of whom have taken to the streets in demonstrations against the right, saying that because of German history, because of the Holocaust, because of World War II, this is absolutely outrageous to have a far-right party gaining in popularity.
And the far-right party is polling around 20%. That would basically put it into second place. Is that in spite of or because of vocal support from Elon Musk and J.D. Vance?
Well, I think that's hurting them, actually. Musk and Vance have been very outspoken in support of the AfD, which has shocked many Germans and in fact, has led to record growth in the far left party just over the last week because of what's happened with this support from Musk and Vance.
So, I mean, Hope, so let's talk a little bit here about what this new government might look like. I mean, most of the official polls and as well as the pontificators on this don't think AfD is going to win here. But when we talk about the new government and how it's going to have to work with AfD, for better or for worse here, should the rest of Europe, and more for that matter, the rest of the world, should we start to take a harder look at whether NATO will still be intact? Some of the military alliances and economic alliances that Germany and Europe have with the rest of the world, particularly the U.S., will still be intact. Is that a threat?
Germans are incredibly concerned, the majority of them, at the change in the U.S. administration and the fact that the Trump administration seems to trust Vladimir Putin more than he does long-standing European allies. So Germany is in an incredibly stressful and really important geopolitical position right now. And the electorate is aware of this because to the east, they've got Russia coming up on 3 years of the war in Ukraine, which Germany has been second behind the U.S. in the amount of support it has given to Ukraine. All of the major, well, except for the far-right candidate, Merz, Schultz, the others have said Putin is an autocrat. We absolutely can't work with him. So they've got this worry on the eastern side. But now with Trump, one never knows. Will he pull out of NATO? And he clearly is backing Putin, not Zelensky, in how to end the war in Ukraine. So Germany, as the largest country in Europe and a traditional leader together with France, is in a really important moment and they feel the need. We are going to have to step up because we can't rely on the U.S. the way we have for so many decades.
So it feels like this election is critical in terms of timing, in terms of what's next. It feels existential in many ways. We're going to go back to the markets here as we look at the election over the weekend. Olaf Scholz on course to not do well. The frontrunner, Friedrich Merz, has pledged to not raise taxes. He is seen succeeding Scholz as chancellor. Are investors mispricing it when they believe that it'll be very quick for Merz to form a coalition government?
The German system, it takes a while to form a coalition government because they work out every detail of all the main policies for the government, and then they all sign. And that it can definitely take months, as it did the last time. Germany's going to be on hold. Germany has been in a recession for 2 years. Yeah. Its economy is under a lot of stress. The auto manufacturers have this competition from China. So investors are, I think, going to be wary for a while and be waiting to see how things shake out and when is a new government actually in place.
All right, Hope, really appreciate your joining us today. Hope Harrison is professor of history and international affairs at George Washington University, and you can catch special coverage of the election on Sunday right here on Bloomberg starting at noon in New York. And Romain, the DAX index in Germany did hit a record high earlier this week. It's since come down a bit here, but there was a lot of anticipation that once they get past the election, for the most part, things are in good shape. Yeah, that's definitely weekend risk. It was down 1% on a weekly basis, kind of snapping that 6-week win streak. And of course, you talk about that record high, but obviously a lot of people want to know what that government's going to look like before they sort of continue to double down on those bets. All right, let's bring in Jess Menton now because we talk about European stocks and how well they've done. And that's part of the story here with U.S. stocks looking less appealing compared to the rest of the world. And when you look at today's sell-off, it feels very much like investors not necessarily have lost faith, but they're diminishing some of their enthusiasm for this America First story.
And even the S&P 500 is about 2% off of that all-time high. And we've seen 3 of those closing records so far this year. But what's interesting about the dynamic, and I wrote this recently for a Taking Stock column, is now we're seeing more buy the dip trends on Wednesdays, not Mondays and Fridays like we would have seen in recent years during this 2-year bull run. And so even 6 of the past 8 Fridays this year alone, you've seen the market lower, specifically on Fridays. And Ryan Dietrich over at Carson Group had some interesting data. Of course, I want to give the caveat if annual. But if you look at this on Fridays, the S&P 5 down on an annualized basis would be down around like 90% on Fridays this year alone.
The last time the S&P 500 rose on a Friday was January 17th before the inauguration. So I am curious, though. I mean, when we talk about the idea that investors were kind of taken a little bit off guard by the economic data that we got today, that trifecta, as well as some early this week. Down at that Miami conference, that Future Investment Initiative Institute that the Saudis put on down in Miami, some of the commentary has been relatively dour. Steve Cohen spoke a little bit earlier today, basically saying he thinks the U.S. economy is going to hit a doldrum in the second half of the year, primarily because of some of those policies. We had Barry Sternlicht on the program yesterday from there. He was also somewhat a little, I won't call him bearish, but certainly expressing some concern here about how tariffs would affect the economy, particularly in the real estate industry. So when you start to see big investors like this now, not necessarily on the bull train, it does kind of make you wonder, is everyone else going to jump off the train soon? And that's interesting, too, when you think about just the dynamics of the last 2 years. There was so much doom and gloom going into 2023 and 2024 about the economy, but U.S. GDP growth, 9 of the last 10 quarters, it still remained above 2%. So really resilient when you're thinking about its counterparts globally and their economies as well. But when you're thinking about from a sentiment perspective, specifically with retail investors, that's been around all-time highs for that sentiment. But if you're looking at AAII, they got another update yesterday. That's pulled backward. It's been 3 consecutive weeks of the bull-bear spread being lower there. And it's the first time we've seen that in a matter of months. So if you're a stock bull, some of them I've been talking to, they want to see more bearish data in the sentiment trend because for them, that gives them more room to go in and buy. They don't necessarily want to see sentiment at all-time highs. So Jess, as we look ahead to next week and think about the catalyst that'll move markets that investors will really focus on, NVIDIA results come out at midweek. The stock is still down about 10% from its record high, so it's in a correction mode. It's not in a bear market. Is there this sense that it's going to turn things around, or this could accelerate the declines that we're seeing?
And we've seen something like this last year in February, because usually the second half of February tends to be more of the weaker time period of the month, and February is the third worst month of the year historically if you go back decades, behind September and August. What's interesting about this, if you're looking at the implied move, if you use the EE function in the terminal for what the day after NVIDIA reports next week, you're going to see that move obviously more elevated than it has been over the last 8 quarters. But the S&P 500 specifically, Citigroup has some data on this on the options side of that thing. It's expected to move about 80 to 90 basis points in either direction following those results next week, because obviously NVIDIA is going to be reporting after the bell. But when you're looking at this, those expectations, there's always those sky high expectations for NVIDIA, but it looks like the implied move is still going to be much higher than it had been over the last 8 quarters.
All right, Jess Menton here, a closer look here at a very consequential day and week for U.S. equity markets. The S&P down 1.7% on a weekly basis, and that was basically its drop on the day, erasing all of the gains for the week and really for the past 2 weeks now. We're going to continue our market coverage, but we do want to take a quick walk down memory lane and take a look back at this day in history. Back in 1947, when the inventor Edwin Land stood before 650 scientists at the annual Optical Society of America meeting in New York, a sizzler. He demonstrated the first ever instant camera. The Polaroid Land camera, which would go on sale a year later for $89.50, used internal pressure rollers to spread the photography chemicals onto paper, all inside of the camera. Then the user snaps a picture, opens up the body, peels the negative from the finished print. It was revolutionary. It gave amateur photographers instant gratification. Even easier to use, Polaroid models debuted in the early 1970s that automatically ejected the finished photo. By 1978, Polaroid was a juggernaut. It had surpassed more than $1 billion in sales, making it one of the 250 largest companies in the U.S. But it was a long journey from the company's early days in the 1930s when Land began selling sunglasses, lamps, and other technologies to polarize light, and during World War II when he turned to military optics. But once the war ended, he needed a new strategy, and the consumer was his big bet, effectively turning photography from a professional endeavor to something anyone could do anywhere. But by the 1990s, Polaroid had fallen behind. An ill-timed foray into instant home movie cameras hobbled the company financially. Its bloat of more than 20,000 employees at its peak didn't help. It had been spending 37% of its sales on admin costs compared to 21% at Kodak. And its sluggishness in adapting to digital photography ultimately doomed the company. Land, who by then held more U.S. patents than anyone except for Thomas Edison, was forced out in 1982. And by 2001, a decade after his death, Polaroid filed for bankruptcy after a decade of stagnant sales growth. Now, Polaroid did manage to find itself back in the zeitgeist in 2003 when the song Hey Ya by Outkast and that catchphrase, Shake It Like a Polaroid Picture, stormed the music charts. But that opportunity, too, was squandered, and by 2008, Polaroid was in its second bankruptcy. Now, the company is still around, though primarily as a brand name, as it no longer does in-house research and instead just develops partnerships with other companies to make new products.
Scarlett? So saying the value is in the IP, essentially.
Yeah, I guess so.
Yeah. Well,
that was a great song, too. Remember when Andre 3000 was like, I'll never perform this song ever again?
I just remember the days of Polaroids. I love those things. But giving away my age here. In any case, let's switch gears and talk about the cost of caring for an elderly loved one. It's putting an increasing burden on many American families. And that's why some companies are on a mission to make things easier for those that can't afford in-home or remote care facilities. The recently launched JubileeTV allows its members to watch TV or connect with their loved ones with the help of its senior-friendly interface. And this is the focus of today's Next Up, where we highlight the entrepreneurs and trendsetters moving the needle in the markets and the economy. Joining us now for more on this is Ashish Aggarwal, CEO and co-founder of JubileeTV. Ashish, it is good to speak with you, and clearly you have identified the problem and come up with a solution. How does JubileeTV work?
It's nice to be here. So JubileeTV is an AI-powered device that converts any TV into a caregiving service. Seniors can stay connected, engaged, and live in their own home longer. And for families, it's peace of mind, visibility, and more importantly, real-time insights so that they can proactively take care of actions and stay ahead of the caregiving race. So this is what Jubilee TV does. It combines AI and TV into a very powerful caregiving surface.
So give us a sense here. So, I mean, just to be clear, like the general idea here is that I would basically be able to control this for my mother or other elderly relative here. What's been the option? What's been the uptake, I should say, for this product, Ashish?
Yeah. The journey has been amazing. We launched this AI-powered device less than 6 months ago, and we have tens of thousands of active users today on the platform. So it shows the rapid growth and the urgent need and the growing crisis we see in the marketplace. All the alternatives are reactive and expensive. Towards the late stage of a senior's life, we are spending over $100 billion of Social Security money just for 1 year in taking care of them. So the only way really to address this problem, when you ask this question, is to empower families with the data and insights, and AI comes to real advantage here in making sure that we can empower our families to take care of the aging older adults and address this growing crisis.
So you're using technology to address this systemic problem. You've pointed out that Silicon Valley has not really paid attention to this massive market. Why do you think that is? Why is no one in Silicon Valley identifying this as something that they should put work into?
Yeah, most of the larger companies are mass market devices, so they are not purposefully built to address this problem. And it's also coming to us really, really fast. Just to imagine that less than 50 years ago, our life expectancy was 40 years or so, and now we grow at 0.6 years for every year we live, 11 years in poor health. So it is coming to us fast. Large companies take time to react. That's why startup like ours, innovative companies like us, funded by Silicon Valley venture capitalists, take advantage of this tectonic shift to address the problem. And that's what we have done with Jubilee TV, converted TV into a caregiving service.
Fascinating project. Ashish Aggarwal, CEO and co-founder of Jubilee TV, part of our Next Up segment here on The Close. And we move from Jubilee TV to Revolt TV. We actually had the chance to sit down with the CEO of a Black-owned, operated multimedia platform, Detavio Samuels, and he shared his thoughts on how to approach DEI amid the policy changes put forth by the Trump administration, and more importantly, how to navigate finding the right audience. Take a listen.
I think if you can build the right mousetrap around the right audience, the opportunity for growth is phenomenal. Like when we think about what Revolt has been doing, we have the most valuable audience in the world. You think about as brands are looking to grow, where can they go? Since 2010, the census has been telling us that non-Hispanic white population is shrinking, that 100% of the growth is coming from communities of color, right? That is our audience. You're talking about an audience that's cross-cultural, 66% people of color. So we reach everybody, but we have that fast-growing, influential audience, right? It's a wonderful space for us to be in.
When we talk about that fast-growing audience, are you taking audience from other places, or is this kind of people that maybe even weren't on in that sort of media zeitgeist now coming to Revolt?
Yeah, no, I think, look, the old guard that used to kind of be number one in this youth culture space, I think many of them have kind of died out. And so I think for us, a lot of the places that we're getting them from, where we're really getting them is from the creators. Revolt is a network that is powered by creators. We have the biggest creators in the game. Carisha, Noriega, DJ EFN, all of them are on our platform. And so a big piece of the strategy is to partner with the biggest voices, the most provocative voices in the culture. And that's a large way of how we bring our audience in.
What's your business model? Is it both advertising-based and subscription-based?
Correct. So we have two revenue models. Number one is definitely going to be advertising. That's the biggest piece of our business. That advertising business since 2020 has grown upwards of 5, 6, 7x. So we've been having an incredible and a phenomenal run on that side. The second piece of our business is on the affiliate linear side. And so we are getting distribution deals with the Xfinities and your Verizons, all of them who have been really great partners to us since the inception of our launch.
We've seen at least 10 executive orders come out of the White House that were specifically targeting diversity and equality initiatives. This idea that these companies should not necessarily be partaking on a platform like yours, at least not with any sort of deliberateness.
Sure.
Are you worried?
Right now, I'm not worried. I think the story is very much to be told. First things first, I'll say Revolt is not here because of DEI. We are here because, again, we have a super valuable, hard-to-reach audience that these advertisers love and are chasing. And our ability to build the best mousetrap to bring them into our machine and then connect those brands to that audience is what got us here, and it's what's going to keep us here. And that's built on the back of a whole bunch of sweat, tears, and sacrifice from an incredible employee group. So one, we're here because we deserve to be here and because the work speaks for itself. As it relates to what's going on with D&I, kind of my my language or my point of view in this moment is to be anti-DEI is to be anti-American. I think that if you go back to the founding documents of this country, you talk about things like e pluribus unum, which means out of many one, right? What is that besides diversity and inclusion, right? We talk about all men are created equal, right? Well, what is that except for equity and fairness, right? And so to be anti-DEI means to be against America's values. I also think it means to be anti-business. And as we've been talking about it, if you are studying, if you are a businessman or woman who cares about the data says that the growth is coming from people of color, right? Black and brown populations. And so if you want to grow your brand, you will bet on the populations that are growing. And then globally, the truth is, our white brothers and sisters, when you look at it from a total pie perspective, are about 10 to 15% of the world. So if you want to go after the world, the globe, you have to be talking to people of color.
Well, that's why they say demographics is destiny when it comes down to it. Nevertheless, you have this federal rollback of DEI programs and initiatives, and I'm curious whether that makes it harder or easier for you to get funding when you need it. You're an employee-owned, Black-owned company, but when the funding needs are there, what does the rollback of DEI mean?
Yeah, that will be to be determined. Our funding doesn't come from nonprofits or foundations. It comes from business people and advertisers and brands, right? And so again, if they are betting on growth, if they're betting on the future where this country is going, we're quickly becoming a majority-minority country. We are the new America media company, Revolt. And so smart brands will continue to bet on us, and we will continue to help them grow their business. As it relates to what's going to happen, I just want people to know the chapter is not written yet. Yes, there's a lot being said coming out of the White House and coming out of government, but it is up to us. It is up to every CEO to determine what this future of this country looks like. It's up to every college student. It's up to every bus driver. And so, yes, it's loud, the voice and the narrative, the way that the narrative is being spun in some sectors. But the story is there's so much more for the story to be told. And so I'm just hoping that everybody kind of takes their seat and plays their role in terms of writing what this next chapter really should look like.
That was our conversation with Detavio Samuels. He is the CEO of Revolt. An important conversation here on DEI, especially as the government basically removes all DEI from the public sphere.
Yeah, absolutely. And we talk about just sort of the rebuilding of Revolt TV and just that overall platform here. And obviously, they have a very niche audience and a very niche cause here. And I think the main message I got from that interview was that he's committed to that, and they're going to just continue trying to do what they do.
He is serving their audience. All right, let's serve our audience and give you a recap here of what happened in trading today. Equities closed at their session lows, and that was for the S&P 500, the Russell 2000. We should note as well that oil prices closed at their 2025 low as well. All 7 members of the Mag 7 down, including NVIDIA, which will be reporting results next week. Yeah,
I'm really curious about the spate of earnings we get next week. NVIDIA and, of course, some of the consumer-facing companies like Lowe's and TJX, Home Depot as well. So definitely another read, if you will, on the health of the economy. And in the mix of all that, we've got a lot going on in Washington next week. They're supposed to vote on that big budget deal in the House of Representatives.
This is The Close on Bloomberg.
The S&P 500 sliding almost 2% on the week and on the day for that matter. All of the other major indices here in the U.S. down on the back of a whole confluence of events. Bailey Lipschultz joins us right now, who helps to lead our markets coverage here at Bloomberg. I don't even know where to start. We had economic data. You had the chaos in Washington. You've got elections over in Germany. I'm told that apparently COVID might be back.
There are a lot of
concerns. What was actually driving this? Because the day started out, it didn't look like it was going to be an awful day. I mean, stocks were kind of down fractionally, but the selling pressure really picked up as we got closer to the close.
I think a lot of those headwinds kind of piled on each other. And when you're going into a weekend, you have uncertainty in D.C., you have uncertainty coming from China related to kind of potential viruses. You also have $2.7 trillion of options expiring today. So there are a number of factors that give people reason to sell. And we've only had 2 Fridays since Christmas close higher. That was going into the inauguration and the first Friday of the year. So we've seen people not want to be long into the weekend. And when you have geopolitical risk, a lot of uncertainty, economic data not overwhelmingly strong, as you mentioned before the break, consumer companies reporting results, and NVIDIA. So there are a number of reasons to not get caught flat-footed on top of that options expiration.
When you look at the price action, you look at the intraday charts, and we're showing them right now, it seems like it's very orderly. You know, it's not like people were rushing for the exits all at once. Treasuries rose, that pushed yields lower. And of course, it's not like this is panic selling. You don't get that sense based on the metrics that you look at, do you?
No, not at all. And I think one of the things, when you look at it technically speaking, we did bounce off the 50-day moving average. So that has continued to serve as a variable of support. So that's something that if you're a technical trader, you want to see. And it doesn't seem like, as you mentioned, there's really much panic. It does seem like maybe there are some algos that are hitting their sell warnings and others kind of wanting to get out of potential positions, so there's not really a rush or concern. And again, when you look at the volume, it wasn't kind of that crazy, which is what you would expect to see when there is options expiration in a number, again, of those headwinds that could drive some selling.
One thing that I thought was interesting, particularly when you look at the totality of the week and really into last week, was the idea that when we had up days, it really wasn't necessarily being led by big tech and the large cap names. It seemed to be much more of a rotation into kind of some of those second tier names, for lack of a better phrase. And I wonder if that's part of the problem, because if you don't have that participation, particularly on a down day like today, like an NVIDIA and the other big names, then that just means the selling pressure just really intensifies because there's not enough weighting in what's being bought to keep the. I mean, Hershey was one of the big outperformers today, but that's not going to lift the broad market.
No, exactly. You make a great point. And I think when you see this rotation into consumer staples, utilities, your safer plays, as you mentioned, you're not going to see an equal index kind of rally. When you look at the S&P 500, your biggest laggards from a points perspective, NVIDIA, Amazon, Microsoft, Tesla. So if those companies are under pressure and your big point gainers are Procter & Gamble, J&J, Pepsi, you're not going to be able to make up that ground. And that's kind of been the debate, whether you're looking at the NASDAQ 100, the S&P 500, it's so tech dominated. So if NVIDIA is down, that's where the market's going to be down most of the time.
All right. Bailey, Lipschultz, really appreciate it. What's the number one thing you'll be watching for next week? Very quickly.
Earnings, consumer companies. I'm fascinated by where the state of the consumer is, especially on the back of those Walmart results.
All right. Bailey Lipschultz covering equities for us here at Bloomberg News. For those looking for some respite from markets, there are movie headlines to be made this weekend because this Sunday is the Screen Actors Guild Award, and we recently had the chance to sit down with Duncan Crabtree-Ireland. He's the National Executive Director of SAG-AFTRA, and in addition to the impact of AI in the industry, the LA native spoke to us about how this year's ceremony will honor the strength of first responders and performers who were directly affected by the recent wildfires. Here's part of that conversation.
There's a resilience to being a performer. There's a resilience to Los Angeles that I think is important. And I think there's a sentiment amongst the community. You know, these award shows are important employers of cast and crew themselves. And so the worst thing that we could do in a time like this is actually to cancel productions that are helping provide people jobs and helping them rebuild and sustain. So I think the right approach, and we saw it with the Grammys, we've seen it with other awards that have happened since then, both televised and non-televised, is really acknowledge what's happened, acknowledge the folks who've helped us get through it to this point, and acknowledge that we need to keep the industry moving forward so that people can rebuild their lives after going through this devastation.
Duncan, the SAG Awards will be streamed live on Netflix, which is curious given that Netflix was on the other side of the strike in 2023. How would you characterize the union's relationship with the streamer now? No hard feelings?
Well, no. I mean, look, these are long-term relationships. It's like a family fight, right? I mean, we've had the collective bargaining agreement we were on strike in 2023 started in 1937. And so it was a very serious fight. Of course, in 2023, we did resolve that fight. Netflix was one of 8 major companies that were part of that battle alongside others as well. And so yeah, there's no hard feelings in the sense that we all want this industry to move forward. And since we successfully resolved that strike, we have rules of the road that I think everybody is on board with. And you know, as far as the show goes, Netflix is an extraordinary partner. They have a real commitment to the creative aspect of the show. And for us, we really appreciate the fact that it gives us a global platform because we're really the only broadcast show of that type that's put on by a labor union, and the chance to deliver that message to a broad audience around the world is something that means a lot to us. So it's a great partnership for the show, and it's a partnership beyond the show, just like it is with all the other studios and streamers that we have collective bargaining agreements with.
Yeah, that's a good way of putting it. Now, of course, the SAG Awards will not feature technical awards because it's all about the performances. So AI won't really be making much of an appearance at the SAG Awards. But I am curious in terms of post-collective bargaining agreement, how AI is showing up in pre-production, if not production and post-production, in the way that most impacts your members.
Yeah, we're seeing the biggest uptake, the fastest uptake of this we're seeing is with respect to making changes in the editing process, sort of fixing problems that occur in production that used to be fixable with traditional techniques that now can be done with AI, perhaps more quickly or more effectively. We haven't seen widespread use of digital replacement or digital replicas at this point, and I think that's a good thing. The companies seem to be taking their time and thinking about that. It is comforting to know we've got rules of the road that are well established in our collective bargaining agreement. And I would say, Scarlett, probably the number one area where we expect to see this impact first is for voice actors. And so we're very, very focused on how it's going to affect actors working in fields as varied as audiobooks to dubbing. That's a real impact that we're already starting to see, and we want to help protect those performers as much as possible.
Well, that issue is swirling around right now, particularly when it comes to the movie The Brutalists. And what, at least based on media reports, was the use of AI to basically make the accents, the Hungarian accents of the actors, a little bit more believable. There's been a lot of talk as to whether that was agreed to prior to the filming, whether that was in the actor's contract, and whether the use of AI would somehow, I guess, forbid or maybe give the perception of forbidding those performances from actually winning awards at the SAG-AFTRA ceremony.
Well, it wouldn't impact their eligibility for awards at our ceremony. And of course, provided the production was in compliance with the collective bargaining agreement, the collective bargaining agreement does allow for the use of AI technology for exactly that type of purpose with the informed consent of the performers. And I don't have any information that suggests that consent wasn't appropriately obtained at this point. But it has been a big conversation, and there is a conversation going on within other awards organizations, potentially even including the Motion Picture Academy and the Oscars, about disclosure of the use of AI, et cetera. I do think, in a way, it is kind of reassuring to know that people do care about how AI is used in the entertainment content that they watch, and they want it to be disclosed, and they want to know whether what they're watching has been altered using AI or replicated. I think that's a good thing for consumers to have that information.
Duncan Crabtree-Ireland, they are the National Executive Director of SAG-AFTRA. Scarlett, are you watching the SAG Awards this weekend?
Yeah, of course.
Are you rooting for anybody in particular?
I kind of like Timothée Chalamet.
All right, well, we'll see what
I was impressed with him on SNL. I haven't seen the Bob Dylan movie yet.
All right, well, you'll be watching that and some things that markets will have their eye on over the full week here. Starts on Sunday with those elections out of Germany. Yeah, this will be a big one, although we pretty much know Olaf Scholz will not be the front runner here. Yeah, it'll be interesting to see how that shakes out. Meanwhile, on Monday, President Emmanuel Macron of France is going to be here in the U.S. Visiting President Donald Trump. And we get earnings start to kick off that day for the week with a few interesting names, including Diamondback, the original fan, Cleveland Cliffs, and Zoom. Let's move to Tuesday, Scarlett. We got Apple shareholder meeting. Are you going to care about that? Well, shareholders will be voting on diversity, AI, child safety, and philanthropy. But I think the earnings will be more interesting. Home Depot in particular, given the state of the consumer. Yeah, absolutely. And also curious about names like Kava, Intuit, as well as Keurig Dr. Pepper. We should point out Intuit and some of the tax preparers actually plunged earlier today. There was no news, but it was a pretty sharp drop here. So something going on there. On Wednesday, we get more earnings. And of course, it's the big one. Yeah, NVIDIA will be reporting results. And I was just taking a look at revenue. It has seen declining revenue growth to 73% from 94% in the third quarter. We're also going to get TJX and Salesforce that day here, which could also move markets on Thursday. More earnings out of names like Warner Brothers Discovery and HP. But we're also going to start to get into the heart of some key economic data. Yeah, jobless claims, durable goods, and pending homes. The economic surprise index has fallen to a 5-month low. So data has not been coming in as strong as anticipated. No one's talking about a recession or anything, but this idea that there's no landing has kind of shifted maybe to perhaps a soft landing. I think Fridays could be interesting too. We get those monthly PCE numbers. Of course, the Fed's preferred inflation gauge, and after the last inflation report. Yeah, a lot of all eyes on that one. All right, tune in next week. We'll be back next week with all your market moving coverage. Balance of Power is up next. on Bloomberg.